Best ever listeners, how you doing? Welcome to the best real estate investing advice ever show. I'm Joe Fairless. This is the world's longest running daily real estate investing podcast. We only talk about the best advice ever. We don't get into any of that fluffy stuff. We got follow along Friday today. I hope you're having a best ever Friday. And like we normally do on Follow Along Friday, we will be talking about what we've learned as well as some observations. And it's all about, and by we, I mean Theo Hicks and I, and it's all about what we can do to help you on your real estate journey. So we're going to kick it off. Theo, how do you want to start it off?
So today we want to have a little conversation about the commercial real estate economy. So we've got a couple of statistics that we're going to go through and kind of just have a conversation about that and see where it goes. So do you want to kind of lead that, Joe?
Yeah. So reading, I have fairly recently been a subscriber to the Wall Street Journal, and I'm really digging it. Lots of good content. I've always subscribed to the Dallas Morning News. Most of our portfolio is in Dallas, Fort Worth, so I better have some intel on DFW through that newspaper. And there are a couple articles and data points really that I've come across recently that I just wanted to point out. And if for nothing else, it's important that we take note of them, and whatever we want to do with them, it's up to us, just like any data or really any piece of information in life. It's up to us to interpret it how we choose to. And one thing that I read was that, and this really surprised me, that mortgage defaults in the United States are the lowest they have been in 18 years. This is as of this past November. Mm-hmm. So over the last 18 years, we have now set a record for the last 18 years. We've now set a record for the fewest or the least amount of people defaulting on their mortgages. And quick fact, fun fact, I looked at the chart and it looks like San Francisco has the lowest default rate. So props to you, San Francisco people. And what I find interesting is, well, what does that mean? Mm-hmm. Because stat's a stat, but what are the implications and why is that the case? We always have to ask the question, why? And one consideration I think that we should take into account is that people are better qualified now for their loans, because the lending requirements did get more strict, as they should have, since 2008. But I mean, we're 11 years now past 2008, so surely it's more than that. Well, then there's something else when we combine this information with another article I came across, and that is that the percent of renters have increased 20% since 2008. And that's probably not as surprising to best ever listeners. But what I found surprising is from 2005 to today, renters have increased by approximately 2%.
2015.
Thank you. 2015 to today. So I think we can all agree that the economy's been humming along quite nicely since 2015. And for the percent of renters to increase, not total number of renters, but percent of total households who rent, has increased since 2015 to today, while the economy has been humming along nicely. Well, that says something about our approach as Americans for renting versus owning. And when you combine how we're at the lowest amount of defaults for over the last 18 years with that we're renting more, I mean, that leads me to believe that, one, people who are qualifying for the mortgages are truly qualified, and two, that we're continuing to be a nation of renters. And Theo, you and I are in the right business.
Yes, yeah. When you initially told me that the statistic about we hit the lowest point in 18 years in regards to the mortgage defaults, I didn't really know how to think about that. But once you mentioned that, it likely has to do with more qualified people actually renting, that completely makes sense, because obviously we're talking over an 18-year point. And, back in 2008, that time period, there's probably people that were not as qualified that were owning a home. And once they, experienced 2008, they're like, okay, now let's just rent instead. You have to qualify for rentals, but the qualification is streamlined and simpler than it is to qualify for a loan. So I'd be curious to see, and I guess the percentage of renters kind of answers this question, but I'd be curious to see, I was at the lowest point of those mortgage defaults in 18 years, but over those 18 years, what was the growth, or I guess reduction, in the actual number of mortgages? And if it is indeed going down, that kind of proves your point that less people are getting those mortgages because they're likely not qualifying for them. Banks aren't doing those crazy loans anymore. They're only they're staying to their strict standards because they don't want to get punched in the face again like 2008 recession. And when you hear that the fact that since 2015, and I guess since 2000, a little earlier, that the economy has been doing so well, during that time people are making a ton of money. You'd expect them to go out and buy a house, and some people obviously are, but if renting is going up, then that means that homeownership has to be going down, because there's only really two options. Mm-hmm. So if renting is going up when the economy is really good, what do you think is going to happen if something bad happens to the economy? And I know, it's been going well for so long. A lot of people, you see this on Facebook, Bigger Pockets, a lot of people doing blog posts with their predictions of when the market's going to take a turn again. Like I just saw an article today in The Economist saying, all these economists are saying that we're headed for another recession. And so, for some real estate professionals, that might scare them. But as a multifamily investor, in general, that shouldn't scare you, because that people are going to have to rent. But then when you see the fact that since 2015, the stock market's gone up a ton and renting is increasing, that number is just going to have to go up even higher if a recession were to happen. Now, the only consideration of why it wouldn't go up even more is that the fact that those mortgage defaults are so low. So it's going to continue to increase by that percentage, most likely. This is just my opinion. But it's probably not going to be as large of an influx of renters if there were a recession, because of the fact that the people that are not renting, that are buying or owning, aren't defaulting on their loans right now.
Right. They're going to stay put with their ownership, and then the renters are going to stay put with renting. And yeah, that you mentioned the elephant in the room, and there's likely a recession coming. I don't know when. There's or at least a correction. But when the times have been very good from an economic standpoint, and the renter percentages are increasing, then it's highly likely that when the times are worse than they are today from an economic standpoint, that the renters are going to at least remain flat, but probably going to increase slightly. So as landlords, having I wonder, and this is something I don't know, I wonder for all the other economic cycles in our history, if rentership has increased during the good times. I wonder if that's ever taken place before. That'd be something to interesting to look at. If this is the first time when the economy has just been flourishing, the percent of households has actually increased for renters, because I would think typically when the economy is flourishing, people historically have been purchasing more homes, but that's what caught my eye. Since 2015, it's actually increased 2%, according to that Wall Street Journal article.
Yeah, I got a note to look that up, because we definitely want to write a blog post, kind of going in a lot more detail on kind of the conversation we're talking about today, and kind of just historically seeing, okay, has this ever happened before? That this economy is doing really well while rentership is also increasing.
Yeah.
Something else too that's interesting that I was I was thinking about as well, is that, obviously I'm looking for apartments in Tampa, but I'm also, still looking to invest personally in Cincinnati. And I'd probably say for the past maybe year and a half, the majority of the deals, actually all of the deals that I get, and I just do the MLS, so I get those automated emails, and then I am still doing the direct mailing, but even on those deals, and I'm not getting many of those, but still, even if ones come through, the prices they're asking for are just so insanely high. And on the MLS, I know those deals are selling close to list price. And from someone who's looking for cash flow, the deals make no sense whatsoever. And so I'm not necessarily, and these are duplexes and fourplexes. I'm not talking large multifamily. I'm just curious to see what kind of the strategy is of the people who are buying them, because they're not cash flowing. It's just, unless they're house, there's just no way for them to actually cash flow. And so I'm just curious to see what's going to happen if there were to be a correction. What's going to happen with those types of properties specifically? Mm-hmm. If those people are going to, even if it's 5% of them that can no longer hang on to their property, they're going to sell them at a reduced price. And so I'm not saying that I'm looking forward to this happening, but when it does happen, I want to make sure that I'm ready to buy, because I really like the Cincinnati market, those duplexes and fourplexes. It's just right now, like even in Norwood, I know if you're not from Cincinnati, you don't know the area, you don't know that area, but it's probably a C area. It's got some low income people. There's a couple of businesses that move in there every once in a while. It's technically not even a part of the city of Cincinnati, so the taxes are a little bit higher. And just a year and a half ago, you could buy a duplex for $120 to $140 that rented for $1,400, $1,600. And now, the past couple of weeks, I've seen those same types of duplexes going for over $200,000 at the same current rent. Some of them are renting for $550 per unit. So you've got $1,100 in rent selling for $200,000. I don't understand how that could cash flow, because you're not going to be pushing those rents any higher than a couple $100.
And that's the thing. Yeah, the only way I can think of is if they have a value add play where they're renovating the interiors and pushing rents. But if you're saying that's not feasible,
it's really not in that market, at least right now. So I'm just curious. I guess the whole point is I'm curious to see what happens to those types of properties, because we know what's likely going to happen to single family. We have an understanding what's likely going to happen on the larger scale, but kind of the middle of the road. And another thing too is that's where people who aren't as experienced, I guess there's a higher proportion of people that aren't as experienced pursuing those types of deals, because duplex and the fourplexes are perceived to be easier than 8 unit, 10 unit, 20 unit, and they're less expensive to get into. So there's a lot. I'm just assuming that some of the people that are buying these properties aren't as experienced as they would like to be. So
yeah, and it's likely those individuals have full-time jobs, which might get affected during a correction, an economic downturn. So then you've got a perfect storm of bad stuff, unfortunately for them, where they could get a hit on their salary or lose their salary with the job that goes away, and they've got a negative cash flowing property, and now you got some trouble. So adhere to the 3 immutable laws of real estate investing. If you don't know what those are, then just Google Joe Fairless 3 immutable laws of real estate investing, and then you should be all right when a correction takes place.
It's funny. It's exactly what I was going to say too. I was in Bigger Pockets yesterday, and someone had asked me all these questions about the economy. I saw a really good response. I was saying, and we've kind of hit that, is that there's millions of factors that go into the economy. So it's impossible to predict what factors going to affect something else that could lead to this. So instead, just make sure his answer was conservatively underwriting deals. My response was 3 immutable laws of real estate investing.
Yep. Yeah, there you go. I mean, that came from interviewing thousands of real estate investors and hearing their stories, and I was like, wait a second, some common things here. What are some common denominators? So the second thing, real quick, so separate from that conversation, the second interesting thing that I thought would be of interest to everyone listening, and this is. While it is DFW specific, Dallas-Fort Worth specific, it is interesting for any investor who is investing in any market. And so the thing I read in DFW, there are about 700,000 apartments in DFW, and they range from efficiency to 4 bedrooms, maybe 4 bedrooms. I haven't come across probably 4 bedrooms, but I'm sure there are. And of the rent growth, the percent rent growth last year for each unit size, so efficiency, 1 bedroom, 2 bedroom, 3 bedroom, and I'll throw in 4th just in case there's a couple. Well, the highest percent rent growth was an efficiency apartment. They had the highest percent increase in rent last year. But there are only 19,000 of those in all of DFW. So if you do that percentage, it's about 2.6%, because I rounded down. There's 714,000 apartments in DFW. 19,000 of them are efficiencies, so 2.6%. What I find interesting is, well, first off, it kind of makes sense because you have smaller unit sizes, and the lowest amount of rent. So when you've got a lot of renters, well, you're going to have a significant demand, and if that's the cheapest option, then a lot of people will want the cheapest option. But what I find interesting about it is, when I started in apartment investing, I used to only want 1 and 2 bedroom apartments, and predominantly 2 bedroom apartments, because they were easier to rent, or so I thought, because with the 2 bedroom, when the times get tough, you can always you can always rent someone who's looking for a 1 and just fill your 2 with that person who's looking for the 1 bedroom. You can, a person who's looking for the 1, they'll rent a 2 bedroom if the price is right, or a concession or something is fine, or is what they're looking for. But if you have all 1 bedrooms and someone needs a 2 bedroom, they've got, a significant other and a kid or 2, well, they can't have a 1 bedroom. Doesn't make sense. And so there's less flexibility. So you have more flexibility with 2 bedrooms. But what this article was saying is, there's such a small percent of efficiencies, at least in DFW, but likely other markets, that they go like crazy and the rent just increases more so than any other unit size. And that's because of recent college graduates. They need a place to live, and they're, for the most part, not moving in with someone. And young professionals too, who are out of college for 3-4 years, they still might be living in an efficiency. And so the takeaway here is, when you're looking at a apartment community and you see just efficiency units, don't necessarily dismiss that as an opportunity, because it might be an opportunity for you to have greater rent increases relative to if it was a 2 bedroom, all 2 bedrooms. Now you'll want to make sure you look at what the vacancy rate is for that unit type within your submarket, within your market. So you want to make sure there's demand, and you want to logically know where those renters are coming from. Is there a college close by, or is that an area where young professionals like to reside? Knowing those variables, you could very well come across an opportunity that's all efficiency, where you initially would have dismissed it, but now after hearing this, perhaps you'll take a second look at it.
No, yeah, I've been seeing something similar in Florida. There's not many efficiencies here. I'm not sure what the number is, but I haven't seen that many on rent rolls. But for the 1 bedrooms compared to the 2 bedrooms, the rent per square foot is, 10, 20, sometimes even 30 cents higher for the 1 bedrooms than for the large 2 bedrooms. And when doing rent comps across 2 bedrooms, it's not necessarily, it's more of, it's a 2 bedrooms rent for this, no matter what size they are, because you have a massive 2 bedroom renting at $900, and then a smaller 2 bedroom renting at $875, and the dollars per square foot are way off because they're renting for the exact same. So I've seen something similar in Florida.
Two things to consider, both from an economy standpoint and also from selecting the assets that you want to underwrite and perhaps pursue to purchase.
Great. So one thing I want to talk about, one more thing before we move into the trivia question, and that is about a book called Traction by Gino Wickman. My business partner read that over break, and we kind of took a 2-week break from having our meetings. And then when we had our meetings, he had our apartment syndication to-do list. It's like a shared Google document. And he had it filled out with the information he learned in the book. And so I haven't read the book yet, but essentially it kind of follows the concept of, if you're trying to fill up a jar with completely, you'd put the rocks in first and then the sand and then the water. And so the rocks are kind of like the priority. So your priority items are called rocks. And so you want to make your 1-year rock, your quarter, and then your quarterly rocks. And so we've got a list of, what are the main things we want to accomplish this quarter. And then based off of that, we create a scorecard, which is very similar to the accredited investor engagement tracker that we have in our client program. And I don't think we've given that away for syndication school yet, but I'm pretty sure we will in future episodes. But essentially, it's a document where you can track all the different duties that you're doing that are bringing you closer to attracting passive investors. So, posting on Bigger Pockets, recording podcasts, things like that. So you have a list of all those, and then you have a goal. And then for each week, we fill in, how many we've done. So, for example, Theo Bigger Pockets posts 50. So how many have I done this week? And then we have an overall to-do list. So when we have our meetings, we can type in, okay, by next week, we're going to have these things completed. I just want to just mention that really quick. I know I went over that really quickly, but one of the things that we have at the top of our rock sheet is the quote, "No deal is better than a bad deal." Just because one of the things that our issue lists was, we've been looking at deals for around, 4 or 5 months and haven't closed on one yet. And so we don't want to, push ourselves to be like, all right, we haven't done a deal in 5 months. We have to do the next deal that we get, even though it's a bad deal. We, budget the numbers and make it make sense. No, having no deal at all in the moment is much better than doing a bad deal and completely screwing ourselves over for, I guess, forever with those investors. So if you want to check out that book, Traction, I'm sure it's a pretty quick read, and it's kind of just turning your business into doing what corporations do. Like when I worked for Cummins, this is essentially exactly what we did as well. So
yeah, it's great. Or I have not read it, so I don't know if it's, but I like the concept of that you're talking about. And what is your quarterly goal that you have?
So I'm filling it out tomorrow, but right now my 3 goals are to underwrite 2 deals a week, meet in person with our broker relationships. So meet in person with them, each of them at least once this quarter, and then train 5 underwriters, which the second is funny because I had 3, and then I wrote this down and I went to Bigger Pockets. They had 2 messages from people who were interested in underwriting. So
cool.
5 right there.
All right. Nice.
I wish I had brought this up last week on our goal setting talk, but fair enough. Alrighty, to the trivia question. So last week's trivia question was, what MSA had the largest population growth in 2017? I think Joe guessed Dallas-Fort Worth, and that was in the top 5 for sure. The answer was actually Boise City, Idaho. So that was the MSA with the largest population growth percentage-wise. So not overall, percentage-wise. This week's question is going to be similar to last week's question, but it's going to be, what MSA had the largest projected population growth in 2018? So obviously 2018 data is not out yet, so they do their projections. So what MSA had the largest projected population growth in 2018?
So the question before that was 17?
Mm-hmm.
Okay, and this is the same question, but for 18.
Yep. So, but before it was actual because they had the data.
Right.
This was the projections.
Okay, and it's percent increase, not total number increase.
Percent increase.
I'm going Fort Worth. I'm just stick to my my guns.
I'm pretty sure Fort Worth was 2 or 3. 2 or 3. So if you don't guess Fort Worth, this one, I think people will get this one. I was surprised, but I think people will get this one because it's not a Boise City, Idaho. It's more of a well-known area. So submit that question to either info@joefairless.com or comment on the YouTube video that we post. And if you get the correct answer, we'll send you a signed copy of the first book.
if you're the first person to get the correct answer,
Mm-hmm.
then we'll send you a signed copy of the Best Real Estate Investing Advice Ever Volume 1. Sweet.
The conference, best ever conference in February 2022, 23, little over a month away. This week, the featured speaker we're going to talk about is John Chang. It's very relevant to the conversation we had earlier about the economy because he is going to do a talk on his take on the commercial real estate economic outlook. So from what I've seen, I think it's just going to be him doing it.
Yeah. What's his
think
title?
it'll be a panel. John Chang.
No, that's his name. What's his title?
Oh.
He's with Marcus and Millichap. He I don't know his title. Maybe you can find it, but I know what he does, and he is responsible for
Senior Vice President,
but his focus is on forecasting where the economy is headed for Marcus and Millichap. He's phenomenal, and it will be a dynamic talk with a lot of value. And it's, our whole conference is focused on commercial real estate. And so he's actually going to kick it off on Friday morning.
Nice. So tickets go up weekly. So you can secure your ticket now at besteverconference.com. And then lastly, we're going to do our review of the week. So if you submit a review on Amazon for the Best Ever Apartment Syndication book, we're up to 117 when I checked this morning, and send us a screenshot at info@joefairless.com. We will send you a package of the free content that the people who pre-ordered the book received. This week's review is from Paul.
Oh, wait, it's not the exact content people pre-ordered the book. We updated it some.
Yeah.
And the reason why is because we wanted to reward the people who pre-ordered the book something extra special. So
okay.
It's a little bit different, but it's still good stuff.
So Paul said, I consider myself a multifamily real estate professional, having financed apartments for over 25 years. But moving from a provider of financing to being a sponsor encompassed much more. This book really helps to organize each step necessary to achieve your goals. Along the way, it goes beyond the mechanics and digs into the mindset necessary to achieve each step. When you combine this with the regular interviews contained in the Best Ever podcasts, the amount of useful information is abundant. I have not attended, but have also heard that the Best Ever conferences are also top-notch. That's on my list of things to do. Thanks to Joe and Theo for the excellent work and continued stream of content. I highly recommend this book.
Paul, I hope to see you at the conference in February, and thank you for that review. And most importantly, glad that it is helpful for you as you evolve your focus in commercial real estate. Enjoyed our conversation, everyone. Theo, great catching up with you again, and we will talk to you tomorrow.